Hey Tony, thanks for having me in today. I know as a shareholder and a stakeholder in Crown Mobile, you've been kind of concerned with things. So I wanted to walk with you, give you sort of my view as to sort of where things are standing today. And we're going to use basically the financial documents provided by the company to do that. The annual statements, auditor reports, and another series of reports to do that. So again, financial statements give us a good view into where the company was at, how things have progressed certainly over the period in the last year, and a good snapshot of sort of where they're sitting today. I've also drilled down into some other financials to give us a little bit of forward guidance on where we think things are going in the future. One key thing is the financials don't tell the whole story, Tony. We have to put the financials together in the context of the decisions that were made inside of the company to give you a better flavor for the whole story. So that's where things like market sentiment and some other things come in. So let's walk through this today. So Crown Mobile has two offices, one in Melbourne, Australia, and the other one in Amsterdam. They trade on the Australian Stock Exchange under the symbol CM8, and they also trade in the Frankfurt Exchange. This is some very high level numbers, but Tony, you know that we're trading basically about 3 cents a share today, and just from an earnings perspective, we're negative 12% earnings overall this year. So it's been a tough story, and we've got a market cap currently of $7.3 million. So 2018 has been a bit of a tough story for these guys. So Crown Mobile is transitioning this year to what they call Crown Media. So I just wanted to make sure that we're clear, because it really has a lot to do with sort of the risk of this thing going forward. They have two main divisions. One is what they call the mobile division, which is sort of a question and answer software where people sort of dial in or email in or come in through the software, and they get an answer back, and it's for a fee for service. They also have some subscription products around gaming and education. The other area where they're headed is what they call their media division. These guys basically want to leave the subscription business behind, principally for regulatory reasons and for profitability reasons, and they want to move into become an affiliate marketing media firm. So that's really where they're headed. Top line revenue number is $38 million revenue, and again, market cap $7.3 million. I've done a bit of an executive summary here, Tony, just to kind of red flag a few key areas, and I'll be going through a little bit of this when I go through the presentation, but at the end of the day, some of the red flag issues are we've seen revenue drop overall, we've seen operating cash flow drop overall, and we've seen a really material drop in the net assets of the firm, principally related to a $26 million write-down of the subscription division in 2018. So they did an acquisition for around $22.5 million in 2015, Track Holdings, which I know you're familiar with. This year they wrote down the whole division. They're basically saying we're not going to participate in a big way in subscriptions. Now, they've guided they'll still receive some revenue from that, but if you strip out the whole revenue for the subscription division, it's about $13 million in revenue. So it's a big deal. They've laid off 50% of the staff, and they're trying to change the expense side of the equation, but writing down that whole division has real serious impacts for these folks. We've had a wholesale change out in the leadership. New CFO, and new COO, Chief Operating Officer. So those are all risks that I look at. Again, as I said, they see the growth in the digital marketing space, the ability to line up customers that come to their platform with advertisers. So that's where they see their business on a go forward. They've invested in about $1.5 million so far. Last year they created $500,000 in revenue for that $1.5 million investment. They're still going to continue on with the Q&A division. It's been a pretty steady revenue generator for them over the years, but they've got some headwinds in that area. They've got stiff competition from Facebook, Google, and some of the other folks that kind of play in that space. The subscription division, this is the serious one. They've written the whole division down, laid off the majority of the people, and the revenue year over year is down 30%, and I think potentially going down even more. So they've said, listen, given that, let's transition. Let's transition away from subscription and to a certain extent the mobile market that's maturing. Let's get away from those regulatory challenges around GDPR, which is a data protection regulation that is really punitive in Europe, or could be punitive in Europe. And let's move towards social media. Let's make a bet on the millennials. Let's make a bet on the social media marketing space. and let's see if we can make some money there. From a financial perspective, again, some of the highlights from the MD&A. It's been a challenging year to say the least. Net asset position down 84% year over year, principally related to that write-down of that division. Revenue dropped 12% year over year. Operating cash flow down 42% year over year. And again, on $1.5 million invested, they generated $500,000 in their new Crown Media division. But that's the future. That's where they say the future is. We've done some major cost cutting in the subscription area, and we'll see if some of that cost cutting can increase their cash flow. But it might also materially damage the ability to generate revenues as well. So it's a bit of a wait and see. The growth plan for 2019. They believe it's in affiliate marketing in Europe, agency growth, and an expanded broker network. Like basically having brokers go out and market their products. Even with that, we're only talking about $2 to $3 million in forward guidance. With $2 million in a sales pipeline, that's not a lot of revenue to make up for the $13 million loss in the subscription area that might come. They're expecting flat revenues overall in the Q&A area, but they're guiding subscriptions is going to be down materially. Here's their income statement. For 2018 versus 2017, in terms of top line revenue, down 12%. Earnings for the year, down 346%. And the net loss at the end of the year, $26 million loss at the end of the year. Principally related to the write-down of the division, but it also had relation to the operating cash flows. The balance sheet. So this is kind of a snapshot in time. Where are we looking at today? Ultimately, from a current asset perspective, which I like to take a look at, we're down 33%. And when we get into the cash flows, I'll talk more about that. Owner's equity. This is sort of the big one. Last year, $29 million in owner's equity, and we're sitting in terms of net assets at $4.6 million too. So a shareholder owner's equity erosion of 84%. Really, really dramatic. Really dramatic. Here's a bit of a story here in terms of cash flow from operations. So we're down 51% cash flow from operations this year, and principally related to top line revenue, sales revenue, and that subscription revenue coming off. And so that is going to be sort of tough to overcome if subscriptions come off even further. This is important. Cash flow at the beginning of the year, cash flow at the end of the year. Basically, we had about a 51% burn rate in cash. So when you're burning cash to that extent, and your operating cash flow is shrinking, you've got some really serious decisions to make. So I did a little bit of forward projections, and I looked at their free cash flow. Ultimately, at the end of the day, last year, 2017, they had $4.4 million in free cash flow. 2018, $2.1 million in free cash flow. So that's not a whole lot of extra cash to reinvest in the business, invest in AI and blockchain and all the rest of it. This is the big one for me. Ultimately, as a shareholder, Tony, and big one for you, you've had a massive erosion in the value of your equity in the business, and your share price is reflecting that. We're a 7.3 million market cap, earnings per share negative 12, 52-week high. We're sitting at a 52-week low of 3 cents. Some key industry ratios and benchmarks. Net profit margin down 67.55%. What else we got here? I mean, yeah, return on equity 150%. Return on assets 88% negative. Negative growth rate. You can see by almost every metric we're below trend relative to an industry standard. And I did a sort of a cross-sectional benchmark against a player in Australia that kind of plays in that space, small market cap company. And even on a revenue perspective and an earnings per share, they're 5 and 6%, a 6-cent loss per share. But they've at least got some equity value. But what it means to me is it's a tough space to compete in. We've got two companies that are kind of struggling in the same space. They got some strong headwinds with the competition. Here's the trading history. Things that come to mind here, 2015, when they did the acquisition, they were 27 cents, and all their options were around 27, 30 cents. So all their options are basically have expired, worthless. Stock's trading around 3 to 4 cents now, and the volume today is less than 4,000 shares. A lot of institutional selling. I went back and checked some charts, February, July of 2018. There were some days where we traded, 4.3, 4.4 million shares. So pretty bad. That means the institutional guys are starting to blow the stock up, which makes it really hard to refinance or do any kind of a future equity issue at any rate. So it really comes down to they have to turn the story around to make this thing happen. And so highly speculative, but more speculative than it was before. They need to reduce expenses and grow revenue. It has to work, or they have to look at other strategic alternatives. There's a material change in the business, and it's the same fundamentally CEO and board that we have. And even given that, there were some major concerns raised in the audit report around reporting of revenues, how they report revenues, around the discounts rate for future cash flows. And I had the same concerns when I saw those discount rates. I just went, these are very optimistic on a story that is very pessimistic. So I had the same concerns the auditors had. Market risk, there's no volume, liquidity would be an issue. Earnings, cash flow, and burn rate are suspect. And likely we're going to head to a dilution equity issue or some type of insolvency event in the future. So that's kind of where I'm at, Tony. We've got a good, we've referenced this up. We've got some good research behind it. I've given you an outline with sort of a summary of my findings and the full detailed financials, where if we want to sort of drill down into some specific questions around expenses or some of the ratios, I'm happy to drill down into the specific numbers with you. Is there any questions, Tony?
Yes, I believe now I don't think there's any questions. I think you've summed it up nicely. I think now I'll just take this to my advisor and ask him how he feels about this.
Yeah, how does it fit in the context of your overall portfolio? How do you see this in terms of the risk? But again, it remains a highly speculative stock, no different than when you first looked at it. But the business drivers are changing. Profitability is low. It's a tough space. They don't have a lot of expertise in the space that they're moving into. And the decision, and the big one for me, was the due diligence around that acquisition that they did to kind of blow it all up less than 3 years later and erode all that shareholder value is really significant. So,
do you think, from a point of view of an analyst, is this company, do you believe, ripe for a takeover? Or would anybody even want it?
That's an interesting question. So there is some value in sort of the Q&A business, and it can drive some steady revenues. And who knows, maybe some of those things chug along. Like in the media, maybe they turn it. The issue is how long can you stay solvent relative to the expenses that you have. So unless they change the expense platform, and unless they start generating significant revenues, you're in a position where somebody might come in after the fact and do some type of preferred debt issue, and then maybe sort of take it over and run it as a private company, where they really sort of trim down the expenses. But those are things to sort of look at in the future. But I'm not sure where these guys would go to today. Ultimately, it boils down to they have to turn the dial on getting revenues, and they have to cut their expenses. That's really where to show that they can turn a profit and restore the faith in their shareholders. I mean, so that even if they did go back to the market, they can go back at a reasonable price. Right now, they've lost the faith of the shareholders, and it's not a good place to be.
Thank you, Bill.
Okay, thanks, Tony.